40 years of U.S. China trade, from equilibrium to asymmetry and the era of decoupling. Viewing the U.S. China trade trajectory from 1985 to 2025 through the dual lenses of macroeconomic theory and financial analysis reveals a profound structural transformation in the global economy. At the onset of this dataset in 1985, the trade relationship between the United States and China was virtually perfectly balanced, with both imports and exports resting at a modest $3.9 billion, resulting in a net zero trade deficit. This equilibrium was characteristic of an era where China was cautiously integrating into the broader global market following initial domestic reforms. Moving forward a decade to 1995, foundational shifts in global supply chains began to materialize. U.S. exports to China experienced a healthy threefold increase to $11.7 billion, signaling growing demand for American capital goods. However, U.S. imports from China surged disproportionately to $45.5 billion. This divergence birthed a trade deficit of $33.8 billion. From a financial perspective, this period marks the inflection point where capital began flowing asymmetrically, establishing early patterns of dollar recycling that would later define the relationship. The decade between 1995 and 2005 represents the most aggressive acceleration phase in this economic timeline. The catalyst was undeniably China's accession to the World Trade Organization in 2001. By 2005, the data illustrate a massive explosion in the trade deficit, plummeting to negative $201.6 billion. While U.S. exports grew to $41.9 billion, imports from China skyrocketed to an astonishing $243.5 billion. Econometrically, this reflects the rapid industrialization of China and its cementing as the manufacturing hub of the world. The United States transitioned heavily into a consumption-driven economy, relying on low-cost Chinese manufacturing to suppress domestic inflation while eroding its traditional industrial base. The subsequent 10 years, up to 2015, saw this asymmetrical relationship reach its zenith. U.S. imports from China nearly doubled again, hitting a staggering peak of $483.2 billion. Despite American exports achieving their highest recorded point in this dataset at $115.9 billion, the sheer volume of inbound goods resulted in a gargantuan trade deficit of $367.3 billion. Financial analysts during this era were acutely focused on how this imbalance fueled the accumulation of U.S. treasuries by the Chinese central bank, financing American debt, while keeping the renminbi artificially competitive to sustain export dominance. However, the final decade from 2015 to 2025 marks a stark regime change, driven by shifting geopolitical realities and protectionist trade policies. The data reveal a significant contraction in the absolute volume of bilateral trade. By 2025, U.S. imports from China will have fallen dramatically by over $170 billion from their 2015 peak, resting at $308.4 billion. U.S. exports have also contracted slightly to $106.3 billion. Consequently, the trade deficit has narrowed significantly to $202.1 billion, effectively returning to 2005 levels. Economists attribute this massive reversal to punitive tariffs, supply chain diversification strategies, and an overarching strategic decoupling. This recent compression signifies an end to the era of hyperglobalization, moving toward a fragmented global economy where supply chain resilience and national security are prioritized over pure cost efficiency.